In this lecture, I would want to focus more on the different classifications of taxation. Remember, in the previous lecture, we looked at three main classifications: the progressive tax, the proportional tax, and the regressive tax. And the purpose of this lecture is to show you in numbers how these three types of taxes actually work, and the reason why they are called what they are called. And so I'm hoping that this series or this particular lecture will be shorter. So let's have a look at a computational illustration of what the progressive tax is. So when we say the progressive tax, we had indicated that it is one that charges a higher rate for people who earn a higher income. So all things equal, the higher your income, the higher the taxes you are required to pay. That is the concept behind the progressive tax. And here I have three main taxpayers. I have taxpayer A, taxpayer B, and taxpayer C. And when we say the progressive tax charges a higher rate of tax on those who earn a higher income, this is what we actually mean. So when you see from the first diagram that taxpayer A's income is 10,000, taxpayer B's income is 50,000, which is higher than taxpayer A's, and taxpayer C's income is 1 million Ghana cedis, which is higher than both of them. That is taxpayer A and taxpayer B. And then you realize that because the taxpayer B and C's incomes are higher than taxpayer A, their tax rates are higher than that of taxpayer A. So for example, taxpayer A pays a tax rate of 5% on his or her income. Taxpayer B pays a tax rate of 10% on his income, and taxpayer C, whose income is the biggest, pays 20%. Okay, so if you do the computation, the total amount of tax each one of them is supposed to pay is actually a product of the income and the tax rate. So the tax base is actually the income of 10,000 for taxpayer A, and his tax rate is 5%. So if you multiply 10,000 by 5%, then taxpayer A pays a tax of 500 Ghana cedis. Now, taxpayer A's income is 50,000. That is his tax base, and his tax rate is 10%. So if you multiply the 50,000 by the 10%, then taxpayer B pays a total tax of 5,000. Now, taxpayer C has an income of 1 million Ghana cedis, and his tax rate is 20%. So if you multiply the tax base of 1 million by the tax rate of 20%, then taxpayer C pays a total tax of 200,000. So look at the size of the taxes. Taxpayer A pays a tax of 500 Ghana cedis. Taxpayer B, whose income is 5 times the income of taxpayer A, pays 5,000, and taxpayer C, whose income is higher than both taxpayer A and taxpayer B, pays the highest. So this is what we mean by progressive tax. Okay. Now let's have a look at another type of tax, and this time I'll be looking at the regressive tax. So we also indicated when we did the first lecture that for regressive taxes, people who earn a lower income pay more in taxes than people who earn higher taxes. And we said that regressive taxes are the opposite of progressive taxes. So once again, let's look at the mathematical illustration here using taxpayer A, taxpayer B, and taxpayer C. Now, we can see that taxpayer A earns an income of 10,000 and his tax rate is 20%. And so if you multiply his income of 10,000 by the tax rate of 20%, he pays a tax of 2,000. And then taxpayer B pays 10%, even though his income is 5 times that of taxpayer A. And so at the end, he ends up paying 5,000. And then taxpayer C pays only 5% of his income, even though his income is higher than both taxpayer B and taxpayer A. So the total he pays is actually 50,000. You'd realize that by the mere fact that he pays a lower rate of tax, even though his income is the highest, shows that this type of tax is a regressive tax. Now, when we say regressive tax, we are not looking at the actual amount paid, okay? We are looking at the percentage of the income that is actually paid in taxes. Okay? So you see that 50,000 as a percentage of 1 million is actually just 5%. So it's only 5% of his income that is paid for taxi in taxes. And for taxpayer A, he actually is actually paying 20% of his meager income. You get it? So that is what we mean by a regressive tax. And then the last type of tax we talked about is a proportional tax. And for proportional tax, we had said that all the taxpayers pay the same percentage of their income in taxes. The emphasis is on the percentage of income. So the tax rate is the same for all of them. As you can see, the tax rate is 20% for both for tax A, for taxpayer A and taxpayer B, as well as taxpayer C. And even though their incomes vary. So at the end of the day, taxpayer A ends up paying 2,000 in taxes. Taxpayer B ends up paying 10,000 in taxes, and taxpayer C pays 200,000 in taxes. So these are mathematical illustrations of the 3 different types of taxes we have. Is there any question from you? So there's noise coming from someone in the background. Okay, so if there's no question, then I would like to move further to look at other classifications of taxes. So taxes can generally be classified into 2. You have direct taxes and indirect taxes. And so when we say direct taxes, we mean that the burden of tax is borne by the person on whom it is levied. An example of a direct tax is the pay as you earn tax. So you can think of the income taxes that employees pay on their incomes, pay as you earn. You can also think of corporate income tax as a direct form of tax. And then capital gains tax and wealth taxes are direct forms of taxes. And in terms of characteristics, or in principle, we often say that these direct taxes are progressive taxes in nature. And then when we say indirect taxes, these are taxes paid by consumers when they spend on goods and services. And examples of indirect taxes include value-added taxes, excise taxes, and customs duty. Now, the effect of indirect taxes may be seen in higher retail prices. Remember, we said that one of the purposes of taxation is for repricing. Okay, so whenever indirect taxes are levied on goods and services, it actually increases the prices of these goods. And so you see that sometimes higher prices of goods and services may be as a result of these indirect taxes. One of them in recent times is the increment in petrol products. Remember, the government has levied or increased the tax on petroleum goods so as to be able to raise more taxes from petroleum resources. And that has resulted in the increment of petrol with consequences on transport fares. Again, so it has effectively led to a repricing of those goods and services. Usually, such taxes are levied equally, irrespective of your income. So think about it, petrol. If the price of petrol increases, it is irrespective of your income. If a liter of petrol is 10 Ghana cedis, irrespective of your income, you buy it at 10 Ghana cedis. And so we say that usually these indirect taxes are regressive in nature. In other words, they are regressive taxes. However, it is good to note that some taxes may exhibit both characteristics. Some taxes may be yeah, so let's move on and look at what is called the canons of taxation. And by canons of taxation, I mean the characteristics and the qualities of a good tax system. So what are these canons? So we'll go back to our studies in economics and make some references to the father of modern economics, Adam Smith. So in his book, The Wealth of Nations, he provides an insight into 4 canons of taxation. And these canons of taxation are equity, certainty, economy, and convenience. So basically what Adam Smith was saying, or is saying, is that any good tax system, or for a tax system to be classified as a good tax system, it must have these 4 qualities, which is equity. It must be equitable, it must be certain, it must be economical, and it must be convenient. So we'll look at the meaning of these 4 canons of taxation and bring this lecture to please, there's noise in the background of one of you. So when we say equity, or equity as a canon of taxation, we mean that the person who is to be taxed according to their ability to pay, okay? They should be taxed on their ability to pay. So for example, it will not make sense to tax people who do not earn an income. If they do not earn an income, and income is a basis of taxation, then it doesn't make sense to tax them, okay? So, and if they even earn an income, you should tax them based on, accordingly, okay? Based on the size of their income. In other words, you should tax those who earn a higher income more than those who earn a lower income. In terms of certainty, the principle says that the time of paying the taxes, the manner of paying the taxes, and the amount to be paid should be clear to every taxpayer and not arbitrarily. So what this means is that every taxpayer should know the time he or she is required to pay the tax, the manner in which he is expected to pay the tax, whether he should send a Momo or whether he should make a bank payment or whatever way that the law prescribes, it should be known to them. And the amount he or she is supposed to pay is supposed to be known. Okay, so that is a principle or the canon of taxation. The convenience canon says that the mode and the timing of payment should be convenient to the taxpayer. Okay, and it means that the taxes should be imposed in such a manner and at the time which is most convenient to the taxpayer. Okay, so for example, income taxes, they are imposed when you earn an income and they are deducted at source. What that means is that the taxpayer doesn't have to go about going to pay the income tax all by himself. Okay, so usually the employer will deduct the tax and then pay it to the government. So that is convenient. And then the last canon of taxation is economy or efficiency. And this principle says that every tax has a cost of collection. So when the government imposes a tax on people, the government has to spend money to collect those taxes. That is why the government employs people to go around in the form of revenue officers to the markets and to various companies to collect those taxes. There's a cost associated with it. And the principle of economy and efficiency says that, or implies that the cost of collecting the taxes should be minimal. In other words, if the cost of collecting the taxes is higher than the amount of taxes the government is going to collect, then it doesn't make sense. For example, if it will cost the government 10,000 to collect 5,000 Ghana cedis, then it doesn't make sense because the government is incurring a cost, a loss actually in collecting those taxes. So fundamentally, these are the four canons of a good tax system. In other words, any good tax system must have these four principles or must be based on these four principles. Is there any question on this aspect of the literature or on this aspect of the lecture? Okay, if there's no question, then I'll bring the lecture to a close. And then we can call it a day and meet next week. Okay.